Okay chaps, afternoon. It is Sunday afternoon on the 4th of October, 10 to 3, and I just want to start off with this. The views expressed here are entirely my own. They are not affiliated with any other person or corporation. This video is for entertainment purposes only. If you decide to trade based on any of the things I have said here, then this is your prerogative. If you are scared of losing your money, don't trade. And now we've dealt with that, let's look at the market. I'm going to discuss the dollar index and the US dollar currency pair, and the reason we're doing this is because a lot of commodities are priced in dollars, and a lot of the world's assets are priced in dollars, and a lot of the world's debt is issued in dollars. In fact, most of the world's debt is dollar denominated, believe it or not. So let's give you a little lesson in the dollar index. What is the dollar index? This is the dollar index. It's a trade weighted basket made up 57% euros, 13% yen, 12% pounds, CAD, krona, Swiss. If you speak to people about the dollar index, don't quote them this. Don't quote the cable rate, the pound against the dollar, because it only represents 12%. A 57% chunk of the index is the euro. So if you're not watching the euro dollar, then start doing it. Okay, let's look at the euro dollar. From here to 1999 is the European Currency Unit, the ECU. The euro itself didn't actually become a trade currency, I believe, until 1999. If someone wants to correct me on that, then that's fine, but that's what I believe. So for anyone who's sort of concerned about the chart data being invalid, don't be, because it's accurate and I've checked with the data provider. Where are we? From this low to this high, the market has experienced a retracement, and it stopped here, and it was a 0.382 retracement of the move from 1984 up to 2008. 0.382 retracement fib number. This low in 2001 marked the beginning of the next leg of the dollar bear market. And this is when gold took off as well. This is when commodities took off, the dollar weakened, commodities benefited, blah blah blah. So let me just show you where these fib numbers came in and why you should always look at fibs when you're trying to do analysis. 0.382 retracement to within 10 ticks. So now we're going to go and look at the weekly chart and see where we are. Now in my view, we're still in a corrective mode. This decline is not done yet. The way I see it, we're going to be having another leg down. This was the deflation trade that everyone talked about last year, the flight into the safety of the dollar, etc., etc. And we're going to have another wave of deflation trade down here. So let's just take these fibs off again, and I'll show you what we're doing. This is a daily chart. This is a A, this is a B, this is a C. And we hit a measured move. And believe it or not, we hit it to the penny. If you add this wave onto this low, it comes in here. Let's show you where. To the penny. The top is in. This top coincided with excessively bearish US dollar sentiment. Just 97% bears. Whole world thinks that the dollar's going to the wall. They can't all get paid on the trade. You have to understand that. They can't all get paid. They can't all be right. Let's go back to the weekly. So it hits the fib projection we were looking for, and we've now got an evening star candlestick pattern, which is a bearish candle formation. Go back to the monthly. There's a lot of resistance around this 145.70 level. Just bear that in mind too. Okay, so let's go back to the daily and see where we are. So the top is in. This is short-term support confluence down here, 144.60, give or take. The market's going to find it very, very difficult to get away from this declining pattern now. So we're looking for dollar strength going forward, probably into 2010, and I'll look to see 120 level on the euro dollar at some point in 2010. So let's also discuss another reason to be bullish the dollar. We've done the technicals. Let's look at the fundamentals. Here's the fundamentals. Governments lead $22 billion in sales of dollar bonds. Germany, Austria, Europe, Spain, Belgium, all issuing debt in dollars. The motivation behind the decision is probably that they think that the dollar is going to decrease in value, and as a result, when they repay the debt, it's not going to cost them as much. The sad fact of this is that this is a classic example of the horse having gone, and now they're trying to close the door. It's absurdly pathetic, but it's a classic case of the government doing something in a reactionary way rather than a proactive way, and the people are going to suffer, and they're just going to be wrong. They're just going to be flat out wrong. So you can see the link up here. If you need the link, you can email me and ask for it. So that's the euro and the dollar index. Let's go to the dollar index quickly and just show you where we are. This is the weekly chart. You can see that we're about to issue a buy signal here on the weekly MACD. It's going to take a couple of weeks for this thing to turn, but that's okay. We'll go to the daily chart and just give you an update here. We've made progressively lower lows, and the RSI has diverged. Progressively lower lows, the MACD has diverged. So looking at the evidence, we have a reason to believe that the market has topped out in the euro dollar. The dollar index has bottomed. We're going to experience a rather substantial rally, which is going to affect the commodities market, namely crude, gold, silver, and any other dollar denominated assets. The extreme sentiment in the US dollar is conducive to a market turn, and the fundamental news such as this, governments and corporations issuing debt in dollars, is just a classic reason to be fading this dollar bearish trade. The evidence points to a bottom in the dollar and a substantial rally intermediate term. And with that in mind, I'm going to sign off, and the next video I'll be looking at is gold and silver.